Two men are standing at the exact same starting line. They are the same age, live in the same city, and both have managed to save $50,000. They both earn a modest American salary, and they both want to escape the rat race. The only difference between them is where they decide to park that $50,000. The first man, let us call him Ethan, believes in brick and mortar. He believes in things he can touch, see, and paint. The second man, Carter, believes in algorithms, compound interest, and the invisible machinery of the U.S. economy. Over the next 20 years, they will both experience massive financial shifts, but one will sacrifice his peace of mind, and the other will have to master his own psychology. The financial industry wants you to believe there is one perfect path to wealth. The reality is far darker, and the math tells a story that nobody at a weekend barbecue wants to admit. Ethan takes his $50,000 and uses it as a 20% down payment on a $250,000 single-family home. He locks in a 30-year mortgage. He finds a tenant who agrees to pay $1,800 a month. On paper, Ethan is netting a few $100s in pure profit every single month. He feels unstoppable. He drives past the property on his way to work and smiles, knowing he owns a piece of the earth. He gets tax deductions for mortgage interest and depreciation. At dinner parties, when people ask what he does with his money, Ethan has a tangible story. He is a landlord. People nod in respect. It feels incredibly real, and the social validation is intoxicating. Carter, on the other hand, takes his $50,000 and quietly transfers it into a total stock market index fund. He sets up an automatic transfer of $300 a month from his checking account to his brokerage. No banks, no mortgage applications, no credit checks, and absolutely no tenants. When Carter WWWRN goes to that same dinner party and people ask about his investments, he says he buys index funds. The conversation immediately dies. There is no social proof. There is no physical asset to point at. Carter just has a login screen and a changing digital number. For the first few years, Ethan feels like he is winning the wealth game by a landslide, while Carter feels like nothing is happening at all. But wealth is not measured in feelings. It is measured in cold, hard mathematics. By year 3, the illusion of Ethan's passive income begins to crack. The rent checks are coming in, but the expenses are quietly eating him alive. He has to pay $3,000 a year in property taxes and $1,500 in insurance. Then, the inevitable happens. The water heater bursts, costing him a quick $1,200. A storm damages the roof, and the deductible takes another chunk of his capital. His tenant moves out, leaving the house vacant for a month. That is 1 month of a mortgage payment coming straight out of Ethan's personal bank account, plus the cost of deep cleaning and listing the property again. Ethan decides to manage the property himself to save the 10% management fee, which means he is now working a part-time, unpaid job. He takes phone calls about broken garbage disposals at 10 at night. His gross cash flow looked incredible on a spreadsheet, but his actual net profit over 3 years is barely a few $1,000s. Meanwhile, Carter has not lifted a finger. His initial $50,000, combined with his $300 monthly deposits, has been quietly compounding. Assuming a historical average return, his portfolio is steadily growing. He spends 0 hours managing his money. He never gets a phone call about a leaking pipe. However, Ethan still has one massive structural advantage that Carter cannot easily replicate: leverage. Ethan used $50,000 to control $250,000 asset. As the U.S. housing market appreciates, that entire $250,000 house is going up in value, growing his equity exponentially. This use of the bank's money is the precise mechanism that mints millionaires in real estate. But as the timeline stretches to 10 years, the true cost of Ethan's leverage becomes undeniable. Capital expenditures are not optional, they are inevitable. Roofs deteriorate. HVAC systems die in the middle of brutal August heat waves. These are not minor inconveniences. They are $5,000 to $10,000 emergencies that can wipe out 2 years of rental profit in a single afternoon. If Ethan hires a property manager to buy back his time, his margins compress even further. And the darkest risk of all is the bad tenant, the one who stops paying and forces Ethan into a grueling, months-long legal eviction process. None of this friction shows up in the optimistic projections sold by real estate courses, but it is the grinding reality of holding physical property. At this 10-year mark, Carter's strategy finally reveals its terrifying power. Compounding is notoriously boring for the first half-decade, but then the math takes over. The gains on Carter's gains are now generating more wealth than his actual monthly deposits. His wealth curve starts to steepen dramatically. He is diversified across hundreds of the top companies in the country. If one company goes bankrupt, Carter barely notices. If Ethan's single property in a single zip code experiences a localized economic downturn, his entire net worth is in jeopardy. Yet to pretend Carter's path is without suffering would be a lie. The stock market extracts its toll not in physical labor, but in psychological torment. The volatility can be vicious. If Carter's portfolio grows to $150,000 and a global financial crisis hits, he might wake up one morning to find his life savings has evaporated by 40%. That drop is not just a digital glitch. It is a gut-wrenching, panic-inducing event. Most average investors break under this pressure. They sell their assets at the absolute bottom, locking in catastrophic losses because they cannot handle the uncertainty. Carter only succeeds if he possesses the iron discipline to stare into the abyss of a market crash, do absolutely nothing, and keep depositing his $300 a month. Fast forward to year 20. The dust settles. Ethan's property has likely doubled in value. His mortgage is nearly paid off, and his equity is massive. However, when you subtract 2 decades of taxes, insurance, repairs, capital expenditures, and the ungodly amount of personal hours he sacrificed, his actual return on investment is far more grounded than he expected. Carter's portfolio, driven by decades of uninterrupted compounding, sits at a nearly identical net worth. They have both arrived at the same destination of financial independence, but the vehicles they drove were completely different. Ethan traded his time, assumed massive debt, and took on concentrated risk to build his wealth. He worked for his money in the trenches. Carter embraced extreme volatility, mastered his own fear, and allowed the invisible hand of the market to do the heavy lifting. He traded certainty for ultimate liquidity and freedom. The ultimate lesson is not that one asset class is fundamentally better than the other. The trap is blinding yourself to the true cost of your investments. Real wealth requires you to look past the flashy headlines and understand exactly what you are trading for that final number in your bank account. The only math that matters is the math that includes everything.